Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's Bull versus Bear webinar. Steve Miley here on the call for Trade Day on Wednesday, the 17th of January. Welcome, everyone. We're going to go through our usual regular run through in here today. We'll take a look at the macroeconomic, fundamental, geopolitical, central bank events that are shaping financial markets right here, right now. Looking at articles from the major news wires. We'll also take a look at the calendar to see what's going on. What are those events that have been shaping the markets and are likely to shape the markets and the price action going into today. And we'll also take a very brief look at the charts at the end of the webinar as well to see what potential levels we're kind of looking at. So first of all, I'm looking back before I look forward. So we're going to take a look at this Chinese day. I did flag this in yesterday's webinar. We spoke about it potentially moving markets after hours. So I'm going to start looking at that and this Chinese data that we had late in the session yesterday for the US time. So early China, obviously earlier if you're in Asia. And you can see, although there's some in green here, some of the headline numbers were, so we basically had the Chinese unemployment rate, the retail sales rate, and the GDP number in here year on year, all below expectations. And that's a real concern on the back of an already negative outlook prospects for the from last year from the Chinese economy. So that hit the Asian markets yesterday and pulled US futures and European markets down this morning anyway. So we had that right. Yesterday we were pulled down. The main thing we saw yesterday and into today was from Waller. We did flag Waller speaking. We did say, remember, this week is the last week. We've got the Fed blackout period starting on Saturday. So this is for that's 2023. So we want 2024. Fed blackout period starts on Saturday. So we only have the next few days, and obviously yesterday and Monday was a holiday. So we had yesterday through to Friday of Fed speakers, and then we're on blackout until the end of January. Fed meeting. So we had Waller on the tapes, and I did focus on this yesterday. And Waller was relatively, for Waller in here, we go and take a look at the Hawk Dove sheet that we have on the site. So do please bookmark this. If you haven't bookmarked this, we'll go to put that into the chat so you can take a look in the chat. So here's the Hawk Dove sheet, and you can see Waller is relatively a hawk anyway, but he was hawkish. Okay, so although that's not what we're really looking for is when a hawk is more dovish or a dove is more hawkish. So Waller is more of a hawk, but he was particularly hawkish in here and kind of highlighted, the potential for, all the reasons, we should kind of delay, hiking rates cutting rates, because so used to us hiking rates, cutting rates. And then also, not to expect, he basically said, don't expect what we've done before. And previously the Fed, once they start moving on rates, whether it's up or down, they're fairly consistent, like 25, 25, 25, sometimes a 50 thrown in, right? So, it's basically once they start, it's fairly consistent. He's saying we're not necessarily going to do that this time as well. So the market had really priced in once they start that we're going to get rate cuts right the way through to the end of the year. Pretty much at every meeting is what the market's pricing in, and he's basically saying don't necessarily expect that, and also maybe not sooner rather than maybe not sooner, maybe later, and that did change. We'll have a look at the Fed tool in a minute, and so the expectations of Fed rate cuts coming sooner and lasting, going right the way through the year has dropped, and that means if we're not going to get as easy monetary policy, that's not as good for stocks. So stocks down as well. So we saw bond markets particularly sell off. Lower prices in bonds equals higher yields. Lower prices equals higher yields. So we see yields effectively going up from where they were, not because they're going to be expecting rates to go up, but yields are pricing in a more aggressive. So the yield curve is pricing in more aggressive rate cuts. And Waller basically saying you might not get those guys, right? So we kind of had this readjustment on the bond market. Bonds markets went lower. The Fed, if we look at the Fed tool, which is showing you the short-term interest rate curve, that shows a less likely to be getting rate cuts. And we'll come to that shortly, and then also then that means stock indices have gone lower, stocks pulled lower. So all of that impacted negatively, and then on top of that, overnight we had that. So we had Waller initially, then we had the Chinese data negative, and then we've also had Christine Lagarde on the tapes as well in here today, saying, yeah, ECB probably will cut rates at the middle of this year, and the anticipation has started growing that maybe the ECB joined in a little bit earlier. And then the final thing to say is we've had UK inflation data, which actually was higher than expected as well this morning. So I know we're not looking at UK markets, you're looking at US markets, but this, remember, inflation is a global phenomena, right? It's prices around the world that have spiked up over the last couple of years, and so we're also looking in other regions. So if UK is starting to go as higher than expected, maybe it means that the US is not going to go down as quickly as expected, same as for Europe and the other major global economies. So we do watch the global data as well. So going back to the in here, so yesterday we had that say we had Waller on the tapes here. And then we had that Chinese data. Flicking onto today in here, there's the CPI data. You can see the expectation was to be at 3.8% year on year for the UK, and the month on month at 0.2. It came in at 4.0 and 0.4, so higher than expected, which is a bit of a concern in here. Eurozone CPI came in bang in line with expectations, as you can see here. And now this afternoon, we're looking into, my afternoon, sorry, if you're in the US, obviously it's your morning. In just under 1 hour's time, we have the core retail sales data. Now, I do have an article in here that I can show you, just a little pre-runner of that we've put up. Well, actually, one of my sons has actually written with some editorial guidance from me. So if I put this up in here, this one in here. So this is a site that I'm involved with and own. And so, yeah, this is all about the retail sales data and also the industrial production data we're coming today. So, why it's important and what we're looking for. So I'll share that in the chat as well. So you can have a look at that. Might start sharing some of these articles also into Trade Day. So, yeah, so this afternoon wrong calendar. That is yesterday's, today's calendar. This afternoon, just under 1 hour, 57 minutes, we get retail sales. Going to be watching for that, and then we also get industrial production at 9:15 Eastern time. Lagarde is on the wires again this afternoon, but has already spoken in here today, so probably not going to say anything too different in here. FOMC member Williams is speaking later today. Now, obviously, Waller had a bit of an impact yesterday. Watching out for Williams. Williams on at 1500. And if we go and take a look at the whole dove sheet in here, Williams more of a dove. So if Williams says something dovish, not too much of a surprise. But Williams says something particularly dovish, then that might have an impact on the market. That would be positive for equities and bonds. And if Williams comes in is relatively hawkish, then that's going to be certainly a big negative for bonds and equity markets. So watching out for Williams later today as well. So those are the focal points going into today. Alongside on the earnings calendar in here, and I'll just filter this to I think we've had most of the stuff that we are expecting though, to the bigger stuff. Where are we? Okay, here we go for today. So we've already had Charles Schwab beat on EPS, missed on revenue. US Bancorp beat on both in here, and we're also waiting for Prologis day, but that should be in shortly actually, because it's before the bell. Okay, so we're waiting on that, but at the moment really the bigger macro stuff dominating markets more than the actual earnings data that we have coming out today. So these two in here from 5 things. This is 5 things to start your day from Bloomberg on the Americas. So risk off mode in here, futures lower because of driven by a paring back of bets on the speed and depth of central bank rate cuts. So prices in swap markets for Federal Reserve rate cuts in March has slipped to about 65% chance from 80. Well, this is basically what we've been looking at in here. So if we look at the March in here, now we're down to 39% chance of rates staying unchanged. So 61% chance now of a rate cut. Remember when we looked only earlier, or yesterday I think, or the day before? No, it was yesterday because Monday we were off. So we were up in here in the 70s, right? And this has been, if I go and show you the historical. Now, if you click on this tab here, historical, I've already done this on another tab. It brings down the historical, and we're obviously looking at If we go back in here, we're interested in what the 500 to 525. What are the chances of us getting a rate cut in here? The 500 to 525. We're currently 525 to 550, and this is in March. So I've already done that and deleted all the others on this tab. So you see in here the 500 to 525 is the only one showing, and you can see in here we're up at nearly 80%. Only when was this? This was on Friday. So Friday we're up at 80%. Now we're down at 61% in here. So, and you can see throughout January so far it's been choppy, right? So the market's shifting. It's some flipping backwards and forwards between expecting a rate cut in March and expecting more aggressive rate cuts going forward. Also, if we go and take a look here on the 18th of December, so terminal rates at the moment we're looking at 375 to 400. So that's 150 basis points of cuts, right? So that's 6 rate cuts, 625s. Okay, this market is that's the best chance. Okay, this is clearly the highest in here. So the most likely odd in here, we're going to be at 375 to 400 at year end. Okay, and that's about a 40% chance in here. And if we go and take a look at the historical, the 375 to 400, we've got this historical in here, 375 to 400. I'm going to get rid of the rest of these. Well, actually, that's been fairly flat, right? It's been choppy so far in January. That's actually fairly flat, So there's the market's still holding on to the hope in here that we do get, but it's only a 40% chance. But holding on to the hope that we get that kind of that amount of rate cuts, 6 rate cuts by the end of this year. Okay, let's go back to the tapes in here. So in the red in here, so negative outlook for interest rates. A little bit of leaning stocks are down in here. Pullback and pushback. The pullback in rate cut bets picked up pace when comments from Waller. We've already spoken about that in here. European central banks as well. We'll talk about, see the articles about Lagarde pushing back on what the market expects as well. And obviously we had that UK inflation data. China woes. We mentioned that in here. The Chinese data saw Chinese stocks lower in here, and oil prices down despite the Middle Eastern tensions in here. The fact that there's concerns that maybe we're not going to get the rate cuts we anticipated, that could mean a fall in demand. Also the China data, China economic weakness in here, and also potential for central banks not to be as dovish in here means then lower global demand, less demand for oil, lower oil price. Okay, so we've got all of that going on. So just running through most of what I've covered already in here is I've got all the headlines in here. So Fed can cut rates this year, absent inflation rebound. So, even Waller as a dove, Fed can cut rates, but Waller's more of a hawk this year. Can cut rates, yeah, but absent inflation rebound. But we just saw a rebound in UK inflation, right? So, and also saying that, look, as long as inflation doesn't rebound and stay elevated, I believe the FSB had to lower the target range, yeah. He also went on to say maybe we won't be cutting them as we have done in the past, as uniform. Okay, so look, Fed Waller says US within striking distance of inflation goals. So some of the headlines positive in here, but future slip as rate cut uncertainty looms. Tesla down overnight in here. Stocks sell off deeper as traders adjust bets. Okay, and they're adjusting the bets because of that. Look, chance of Fed rate cut in March falls from around 80% Friday to 65% now, or even below now. And here's the headlines about Lagarde from the ECB. President Lagarde says likely ECB will cut rates in the summer. Okay, so but maybe not. Look, policymakers have been pushing back against market wages. So the market's getting too far ahead of itself. We did speak about this potentially happening in Q1. I've been on TV interviews recently talking exactly about this, that we're going to have maybe the Fed push back because the market's got too far ahead of itself. See the Fed push back. That could give longer term buying opportunities, in my opinion, in Q1 for what will still be a positive year for stocks. Market heed central bank pushback against aggressive rate cuts. Look, ECB, Bank of England, Fed, okay, tapering the bets on that. China economic disappointment. We've already mentioned all of that. Again, China's 2023 shows patchy economic recovery. We've covered that already. So all of this, I've gone through and covered really. UK inflation shows surprise, denting Bank of England rate cut hopes in here. What else do I have for you? Stocks hit by rate cut pushback. China takes a beating. It's all the stuff I've gone through already, right? So I've just kind of already summarized all of these headlines that we're going through now. And oil down because of China economic recovery. Also dollar strength. Remember, Oil is quoted in dollars, so dollar strength is negative for the price of oil. Oil in retreat as risk-off mood swamps impact of Middle East crisis. So despite the Middle East tensions in here, concerns about the risk-off mood coming from, here we go, not exactly economic growth and the dollar extension, the dollar rally in here. We've already covered the CME tools in here. What else do I have for you? Bond yields in here. So bond yields nudging back, as we said in here. If this will load, if it doesn't, I'll just skip through it because I've already got the charts. I'm going to skip that rather than waiting for that to load. So you can see in here the damage done. Look at the Hang Seng. Okay, so the Hang Seng echoing the Chinese stock index. Okay, the Chinese stock market down 3.7% this morning. Really pulled down by that data in here. European exchanges by both Lagarde, by the comments from the US being down yesterday, plus then the overnight from China, plus then the comments from Lagarde, the FTSE, and then also then the UK inflation data pulling the UK market. So the UK FTSE down in here 1.8% this morning. The German DAX down just over 1%, nearly 1.2% on the French market, the CAC. And if we look at US futures in here this morning, what do we see? So we're obviously marginally down yesterday. It wasn't a big down day yesterday. We're down by about 4 to 6 tenths across the major indices. But this morning again in here, down another 3 tenths, 4 tenths on the Nasdaq, 3 tenths on the Dow, and the mid cap in here getting beat up in here, 8 tenths down this morning. A quick nod to the charts. I'm not going to go into too much depth in here, but here you can see the bonds in here. So this is the 2-year note bonds selling off. Selling off yesterday. Obviously we're closed Tuesday, having rallied in here. This is the 2-year note rallying into the end of last year, which kept stock indices looking healthy in here. But then yesterday and then overnight, this is today's data in here, overnight already this morning, the 2-year note pushing notably down, and similar with the 10-year. We're still not breaking down through like big support levels. We're still above notable support levels, but it does look a little bit more wobbly in here. And it's a similar story for the equity indices, looking a little bit more wobbly. But as we said yesterday, look, we're just pipped below this support in here. This isn't the S&P. This was Thursday's range when we had that CPI data. So we've just got to nudge that down at that support. So you got this low in here from that day was at 47.72.75, and you also got this little low in here at 67.5. So that's 72 to 67 area. And this morning we've held at 68.75. So just holding in that zone there and trying to rebound. On the Nasdaq in here, similarly, look, we've not actually didn't even go below yesterday's low so far overnight in here, and we're still way within that Thursday range. Until we break out that Thursday range, I don't think the market's really telling us anything at the moment. And there's not a lot really this week. We could have a fairly quite choppy sideways week. Retail sales might tell us something, unless we get a Fed speaker come out say something particularly hawkish or dovish. It could be that I don't think we're going to be completely confined to Thursday range, but it could still be a choppy sideways week, and I wouldn't be surprised to see that go through this week as well. The market's actually holding up fairly well, considering you think what we've had in here over the last 24 hours. We've had Waller being relatively hawkish. We've had the ECB president of the ECB, Christine Lagarde, pushing back, so not particularly hawkish, but pushing back against dovishness. So that should be negative for stocks. We've had that China data, really quite negative in here. And all of that as what we haven't seen, though. We have the UK CPI number as well, higher than expected. We haven't seen stocks significantly break down in the US. We're still within those ranges from Thursday. So despite all the negative news, stocks are holding in. So we're if we go and take a look at our outlooks in here, we're remaining bullish in here. So whilst we're above, so we came right off of that support there, 47.67.5. That's the one we flagged. We came right off of that this morning. Okay. So whilst above that on the S&P, we're holding on to the bullishness. 16.753 is the line in the sand on the Nasdaq on the downside. Whilst above those, staying bullish. Okay, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another bull versus bear webinar tomorrow on Thursday. Bye.